Hey, everybody. We are so excited to have Brian Adams from Excelsior Capital on. Brian, welcome to the show.
Hey, thanks for having me, guys.
All right, Brian, let's dive right in here. And from the About page, or when you dive a little bit into what Excelsior Capital does, you specialize in yield generation. And how is this typically achieved by your team for the investors that you work with?
We do three things: give people access to direct commercial real estate investment opportunities, solve for yield. So we're trying to track to that 10 to 12% cash on cash annualized yield that we send out in monthly distributions. And then we give people all the benefits that come from direct real estate ownership. And the way that we solve for that yield is we go out, we find commercial real estate opportunities, typically in that 8 to 9 cap range. We put on about 60 to 70% leverage. And these are day one cash flowing, well occupied buildings. So within 30 days of closing, you're hopefully be getting that coupon that comes out.
Nice.
Love it.
Now, for people who may not know, Brian, because we have a wide range of folks who listen to this show, what is yield generation? Can you talk to us just a little bit about that? No, that's fine.
So when you do an investment in commercial real estate, you can look at a lot of different metrics of returns, right? So you can look at IRR, internal rate of return. You can look at multiple on invested capital. And those are all kind of important things that we certainly do track. But for us, and the problem of our investor base, people really are searching for passive income, right? They're looking for a way to achieve yield on their money, which basically means that if you invest $1 for 10 years, what are you going to get on a cash on cash basis on that dollar? And right now, given where dividend paying stocks are, given where fixed income is, and really even given where private junk bond debt or private credit is, finding something that's above 6 to 8 double digit on a cash on cash yield basis is just a real challenge. And so that's what we specialize in. That's where we focus. And that's the problem that we're trying to solve for. And for us, the math is pretty straightforward. The goal is that if you were to give us $100 and invest in one of our deals, that every year you would be getting $10 in return on that initial investment.
Nice.
Love it. And for our listeners out there, can you further define what commercial real estate is? Because I think commercial real estate for apartments, for example, any units greater than 5 is technically commercial. But I feel when you're talking about commercial, we're referring to, multi-use buildings, that type of thing. But I want to let you explain.
Yeah, absolutely. And you're right. I mean, that's a term that gets thrown around a lot. It's a big tent. It can mean a lot of different things to a lot of people. So I appreciate the question. For us, the way that we term commercial is pretty much anything that's not residential. So we don't do any single family. We don't do any multifamily. It is historically for us office, flex, which is kind of that single story product that you see that might be retail or office in the front, but has some kind of distribution or industrial uses in the back. That's a flex type product that we like a lot. Or it could be straight industrial usage. It could also include medical. So maybe not a true medical office building per se, but think about a building that might have partial office in it, but then might have a LASIK eye center or a dialysis clinic, et cetera, in it. That's kind of a medical arts uses that we like to see a lot. So the nice thing about being a fundless sponsor, which is a term that I might have to define as well, but we can go where we find opportunity. And for us, going back to those three problems that we solve, that's the focus. But the product type and the geography might change a little bit deal by deal.
Nice.
Yeah, we'll probably have to further define. What did you say? Fundless
partner? A fundless sponsor. So in our world, we are a syndicator, which means that, as opposed to investing into a blind pool of a fund where I say, hey, I'm going to try to do these things, or I'm going to try to look for these opportunities, and this is what I'm hoping to do, and you just trust me and you go along for the ride. We only raise deal by deal. So I find a particular building, let's say it's a building in Chattanooga. That's the deal that we're working on right now. If you were to invest in the Chattanooga opportunity, it would purely be that one specific building. There'd be no cross collateralization or exposure to other assets, et cetera. And in that world, that's termed to some people as a fundless sponsor. So I'm the one sponsoring the deal. I'm finding the opportunity. I'm raising the capital. I'm managing the asset. But I don't have any discretionary capital outside of the money that we invest ourselves.
Okay.
All right. That's helpful. Now, Brian, I know you say part of your strategy is to look for strong underlying economic fundamentals. What does that look like?
Yeah. So those three problems that we're trying to solve for, that's what drives our asset level acquisition, kind of the building by building analysis we do. But overlaying that, we have an investment thesis that says this maturing millennial generation, which for a long time, the Wall Street narrative was they were never going to leave Brooklyn, that they're always going to wear skinny jeans and eat avocado toast and never have children, that wasn't necessarily the case, that this, because of 2008, that family formation phase got pushed back a couple of years, but that they were entering into that world. And because of that, they were going to make choices about where they live, work, and play based on quality of life, cost of living, access to single family homes, and access to education for their children. And that led us to secondary markets, which means kind of not the New Yorks or the Chicagos or the LAs of the world, places like Richmond, Virginia, Chattanooga, Tennessee, Detroit, Nashville, Kansas City. We have a list of these places. So those define kind of the major metros that we focus on. And then when you talk about kind of the underlying economic trends that we like to see, we're focused on eds and meds. So education, healthcare, and typically some kind of STEM, knowledge-based economy drivers are we like to see because they're counter-cyclical and they're really resilient during downturns. So once we have kind of the cities that we like, then we go dig in deeper and understand, okay, well, what drives that economy? And we like to see things that are, differentiated from financial services or purely tech.
Yeah, I thought it was interesting you mentioned Detroit there.
Yeah. So
what do you guys think about Detroit right now?
Yeah, we're bullish. It's been a tough story, right? We all know that the Midwest, Detroit, Cleveland, some of these other markets have really suffered pretty dramatically with a shift away from production and manufacturing. Mm-hmm. But what we've seen is that pricing reset has allowed a lot of people to go back into the marketplace, and the population has not even plateaued. It's starting to come back a little bit, but it already has this great infrastructure in place. And so the suburbs of Detroit, I think, are really primed to do very well here, especially as you see Chicago implode in itself because of its tax regime and a lot of the local political issues that they're having. So these other Midwestern hubs, I think, are going to benefit directly. And we're hopefully, knock on wood, about to close a deal next week in the Birmingham area, which is a really affluent suburb of Detroit.
Love it. All right. So there's a focus here on real estate, and I want to ask why that is. And for context, on your website, there's webinars about blockchain technology. There's webinars about investing in the hospitality space. But from our discussion so far, a lot of it is primarily in the commercial real estate side. So why is that versus an up-and-coming technology like blockchain, for example?
Yeah. So the content creation and the marketing we do, it's an effort to educate our peer network and be an industry expert on behalf of our investor network. And I think part of that, as a fiduciary and as a partner and as somebody who has a relationship with these investors, it's not just to show them my opportunities, because they can find those opportunities elsewhere. Another part of the value that we add to our investors is giving them exposure to managers and professional financial services folks who I know to be high caliber that they should be aware of, right? And so things that are topical, like crypto, digital currency, blockchain technology, is now the time to invest, or is it still, should you stay in the sidelines? The nice thing about my business is I'm not a wealth manager looking to try to get all of their assets under management. I'm fulfilling a small little niche for them, right? Giving them exposure to commercial real estate that gives them current yield. But I think it's incumbent on myself and the firm to be a value add beyond just showing them our deals. And so a lot of what we do are webinars, blog pieces, podcasts, just with people that we think have compelling stories or provide a service that they should be aware of. And so I think that's what you're referring to.
Yeah,
Nice.
exactly. Yep.
It's fascinating because Kevin and I do a similar thing, although we focus on real estate, and that's definitely our favorite asset. We like to have some folks on occasionally who can share about completely different things. We had a stock investor on not too long ago, and things like that. So appreciate that you're doing that. Now, what I'd like to ask you a question about COVID, because we're going through this at the time of the recording, and the commercial market has been affected by that. Can you talk to us a little bit about what you're seeing and how you see the commercial market's been affected by COVID-19?
Yeah. So, we're about a year into this thing, and clearly it's really impacted different spectrums of commercial real estate. And I'll use that in the holistic sense of the word, across the spectrum. The way that I termed it early on when people asked me that question is it's kind of a tsunami or a flood that is coming. And it's just a matter of what part of the elevation level you're on, right? It's going to come for all of us at some point. So clearly hospitality and retail were really impacted right off the bat. Office and multifamily were probably somewhere in the middle. There's a lot of unknowns, and it really depends on where you were located geographically. And then you had really insulated product types. So self-storage, data center, pure industrial distribution plays, they actually benefited from COVID. So that's kind of the state of play as it was 3 months ago. I think the tide is really turning pretty dramatically here, where, with the vaccine rollout, with people just frankly getting back to business. Again, it's going to be geographic dependent, but I think you'll see kind of a continuation of all those asset classes coming back, but it'll be in reverse order, right? So I think office and multifamily, you'll see them turn the corner here pretty quickly. Retail's got some secular issues that I think we're going to have to deal with. And then hotels, I think it's going to be another 2 or 3 years, unfortunately, until they come back fully. But again, I personally think that after Labor Day, Q3, Q4, when the economy is really back open and there's all this liquidity in the system, I think you're going to see things really rip. And that's going to play out across all the asset classes and the food groups. And there's just so much liquidity in the system looking to put money to work that wants exposure to these assets. And again, that thirst for yield is real amongst the taxable investors. So I'm bullish across all of them, to be honest with you, with the exception of retail. I think COVID just kind of was the final straw that broke the camel's back for a lot of these malls and tertiary retail users.
Absolutely. Amazon is kind of taken over that retail experience, right? If I don't have to go in somewhere, even with clothes, you try something on, you're like, oh, it doesn't fit. You just put it in a box and send it back. You don't have to go into the retail stores, as you mentioned. And speaking of commercial space, Adam and I both work in tech, hence Tech Guys Who Invest. One of the common trends is working from home, working remotely. But for some sectors, that's greatly affecting the commercial real estate. Do you see that trend going to continue, or do you see it kind of changing in a different way? What are your thoughts on that?
Yeah, it's a fair question, right? So we have about 2.5 million square feet total. Probably 2 million of it is suburban office. So I can speak to that. And what I can tell you is our collections have been strong. Our occupancy has been strong. As you would expect, new leasing momentum and lease renewals have been muted. It's been slow, as employers aren't really sure what they should be doing. And long-term strategic planning has really kind of pressed pause for the most part. What I think will happen is pre-COVID, about 4% of the workforce worked remotely, right? Which is different than working from home. There's a big distinction to be made there, so we can address that. Clearly, in a post-COVID world, more people are going to be working remotely and working from home than they were before. That being said, this trend that we saw, which we call the WeWork effect, where densification was the key, more people working in close space, either bullpenning it in cubicles or hoteling or desk sharing. In some of these locations, it was down to 75 square feet per user in a WeWork location. A traditional office layout is around 350 square feet. So what I think you'll see is the pendulum swing the other way, where people, when they come to the office, they're going to want to focus, get work done. They're going to want a traditional office layout with a door where they can be quiet and get things accomplished. But also, you're going to see office become a place where collaborative creative thinking occurs, where people can get together in a group. They can, especially in the sales, development, marketing, executive functionality. I think what you've seen is that initial spike in productivity that occurred in Q2 and Q3 has really turned into isolation, challenging times to get things done as a group. So you'll see a return to the office for those parts of the business. But there are some, if you're a programmer or you're purely doing something that doesn't require a lot of interaction, I don't see why you would go back to the office, honestly. So it's going to be something where the way that we use Office will change, but it still will be a really big part of our professional lives.
Yeah, that sounds spot on based on the conversations I've had with executives in my day job as they're reviewing their strategy for office space.
And I think you could see, you read a lot of headlines about these big tech companies, which, listen, that's the future of the economy, right? I mean, this is what's driving things moving forward. But when you look at what they did, what Facebook, Microsoft, and Amazon did during the worst of the downturn, they bought real estate. They bought cheap office product. They bought leases that they could at a discount. And that clearly shows that they think the office is still going to be a big part about how they do things. And I think it's important to understand that if Twitter or another company says we're abandoning, and I think Dropbox abandoned their San Francisco lease, doesn't mean they're not going to have an office. It might just mean that their workforce is distributed across multiple hub and spoke secondary areas where they just kind of have people and offices based on where folks live. But it doesn't mean the office is going to go away.
My CIO and I were having a talk about this very topic recently, and his thoughts were the office is going to be used primarily for those collaborative type sessions, just what you said, Brian, and I totally agree. And he kind of sees a lot of what you said, where the people who can work from home will do that, but when they'll come into the office will be for those sessions where they should collaborate. And a lot of these modern tech companies have a lot of those sessions when they're doing some product design sessions. They'll want to get people together, and that's what they're going to be using that space for. So it's just real interesting to think about how the way the space is used is going to be changing, but it sounds like there's still going to be demand for space.
Yeah. And I think it's important to caveat this with, we all suffer from recency bias. We all think that the way we spent the last 6 months is how we're going to be spending the next 6 years. And no matter what the topic is, that's typically not true. So the difficult thing about commercial real estate from the office perspective is my weighted average lease term, right? So the average length of time that my leases are in place, weighted towards how large those users are relative to my entire portfolio, is north of 5 years. And if those businesses are doing well and they're paying rent, it's hard to know what's going to happen until 6 years in the future. And so any prognostications you see there, I think, is a challenge. Now, I will say, I think New York City and I think San Francisco and some of these other places are going to have a very hard time. But that's really because COVID allowed employers political cover to make moves that they wanted to make before COVID and go to, more business friendly and tax friendly jurisdictions. So I think that's kind of a red herring and a false narrative that you see in a lot of these media publications.
Never looked at it that way, but I can see what you were alluding to. So that really does make a lot of sense. So when it comes to due diligence for commercial properties, what would some tips that you have? And the context I'm coming from is, let's say an investor is listening to this show, one of our listeners wants to invest with you and they want to invest in a particular project. We always advise them to do as much due diligence on their end as possible, right? We want them to not just to go in things blindly, because then you might as well just gamble your money. So what would you advise them to look at in terms of, hey, this is a commercial property we're evaluating. What are some due diligence tips you would have for them?
Yeah, we could start on the asset level. And I think the most important thing that investors should pay attention to is you're going in basis. But what I mean by that is, what is the sponsor paying for this property on a per square foot basis and then on a cap rate basis? Because, well, a lesson I've learned through some hard, mistakes being made and my mentors is you can never escape that basis. You're married to it. Once you do that deal, your entry basis, what you're paying per pound for that deal, what you're paying relative to the NOI that is created by that deal, will never go away. So if you're going in at a pretty high number, and it's going to change based on where the deal is and what it is, but you can do some research pretty quickly and understand what the cap rate is and what you're paying per square foot. If it's pretty steep and they're making some pretty aggressive assumptions on the back end of what they're going to exit at, you should be really careful and understand what you're getting into, right? Because you can go underwater in those deals pretty quickly. I think the biggest question that investors don't ask that they should, it's actually not about the deal, because on some level, you just have to trust the sponsor knows what they're doing, right? Because you can do a lot of diligence, you can ask around, you can be really good, but if the sponsor throws a bunch of stuff out there, there's only so much that you can do in terms of homework. The biggest question they should ask is, what type of infrastructure does this sponsor have on the small business part of their business? So not related to the real estate, but do they have institutional level reporting? Do they have an HR department? Do they have a marketing group? Do they have an internal controller? Do they have an employee setup? What does their investor relations software look like? What does their CRM software look like? What is the experience going to be being an investor with them? And that's just a different type of risk that investors, for whatever reason, don't typically ask. They really focus on the deal, which they should. But more likely than not, the deal is going to be what the deal is, right? We all want it to be a good deal. But your experience can really be dramatically different based on the infrastructure that sponsor or group has.
Love that answer. Don't hear that very often on my side either. And
most sponsors don't want you to ask that question.
yeah, that may be true. But I think that's really good advice. So if you're listening, make a note of that one. So Brian, what are some common investing missteps you see other syndicators making, if you do see that?
Yeah, I mean, I think I alluded to it earlier. Penciling in just really aggressive cap rate compression, which basically means that you're making an assumption that the world is continuing to be an incredibly competitive place, and that apartment deals that traded at a 6 cap in 5 years are going to trade at a 5 cap, just because market dynamics are going to compress those cap rates down. Those are really dangerous assumptions in my mind, because nobody has insight into what's going to happen on an interest rate perspective or from a macroeconomic perspective. Those things are well out of our hands, and you can't control them within the deal itself. So I think that would be something that I'd be really cautious about. And then another mistake I see made, and I mentioned this before, but just to be real, it takes a lot of money to run these businesses. If you look at the asset management fee, if the sponsor's taking an acquisition fee, and if you run the math, it might seem like a big number, but for me, I have 15 employees. And my controller is a CPA with a public accounting tax background. He's good. He's not cheap. My acquisitions folks have CFA level 3s, a master's in real estate. They're good, but they're not cheap, right? So I think what you really have to understand is, does this firm have the wherewithal to continue to provide excellent service and excellent investor experience to me? Because at the end of the day, this is probably not going to be the primary driver of you being a wealth creation for you, right? This is a way for you to get exposure to some things that otherwise you might not be able to. But that experience that you're going to have from an investor relations standpoint can really impact how much energy and psychological work that you put into these things. And a lot of sponsors they're deal guys. They're not small business owners.
very good way of looking at it. It's almost like if you're going to scale and do things right, you want to treat it as a business as opposed to a little one-off, onesie-twosie type of shop.
Yeah. And if they don't take their marketing seriously and they don't have a good fundraising mechanism, if you invest $50,000 or $100,000, that's great. But unless they have the ability to go raise the rest of the money, that deal doesn't happen. You don't get exposure to the deal. So I'd really understand kind of holistically what their business looks like. And, for me, it's a couple $100,000 of a payroll. And it took a lot of time to get here, but we're excellent across the board there. The deals are the deal is going to be, but I can be very clear with you what you can expect from the experience part of it. And I think oftentimes that gets put on the back burner by a lot of entrepreneurs.
Good point. Very good point. Now, I wanted to ask you, you were talking about earlier when it came to content marketing, being subject matter experts, educating your investors in a particular light, kind of how what we do, but there's a focus on real estate. From your experience in getting educated to educate others, what would you say is an asset class that's often overlooked at this point in time?
I feel like every asset class has been so inflationary lately that it's really hard to come up with anything. I personally think one of the most interesting asset classes today that's starting to get a little bit of exposure, but not a ton, is energy and commodities. Energy is with the whole Texas debacle and Biden's shift to green. This is not a political statement, but just a reality. We're not there yet. And oil and gas is going to continue to be a really big part of how we function as an economy. And it's just been so badly beaten up. And it does have some headwinds there, but I mean, at some point there's an entry price and a lot of people are going to do well. And the same can be said for the commodities side. It's been beaten up pretty badly, but you've got to think with the economy opening back up, that there's a real opportunity there. So that's one of the things that my family, when we look to put some money to work during kind of the worst of the pullback, we looked at energy, commodities, and travel and leisure.
Awesome. And then the flip side of that is, what would you say is an asset class that's overrated, maybe overinflated, similar to what you were talking about?
Man, I'm not going to cater to my audience. I'm going to say, tech. I think it's unjustifiable, some of the valuations these tech companies have. I think the latest numbers I saw, and this is before the recent pullback, but Tesla was priced as if every car was going to be worth about $3 million. That seems aggressive to me. So tech has become such a huge part of our lives, but at the end of the day, the fundamental business has to make sense. And I think some of the valuations that are put on here, it's just really hard to stomach as an investor.
Not to bash on the stock market, but I feel like I see that a lot with a lot of these tech companies, and it not just recently, but I just feel like I don't understand where some of those values come from, and it would make me wary of it.
I mean, growth has been the story, right? It was, we'll figure out how to make money later. Let's just rip it, and we'll just drive revenue, and we'll figure out how to be profitable at a later date. And these valuations keep getting bigger, and this ecosystem that you saw of these venture firms that just started acting like private equity groups, where the system fell apart unless you kept growing. And that's what happened with WeWork, right? I mean, they had an unjustifiable valuation, but venture guys kept making money along the way of the ecosystem, at least on paper. But they got to the end of the line, right? SoftBank was the biggest animal in the jungle, and when they couldn't go IPO, because the Wall Street research analysts looked at the numbers and said, this business sucks, the thing it fell apart, right? So that's where this whole SPAC concept is really fascinating to me, because, and it seems like it's Wall Street versus tech. Wall Street wants this IPO process, and then the tech guys want the SPAC process to intermediate that or disintermediate it. But I think there's still a lot to be said for having to go through these really, really smart research analysts that are deep industry experts to figure out whether or not these companies fundamentally make any sense. That being said, the amount of liquidity in the market and how the Fed is behaving, there's not a lot of alternatives, right? I mean, if you have cash and you're not going to go to fixed income because it's terrible and private credit is tough, you're going to put it into the market. You just have to. So there is no alternative. And, tech is kind of the where there's been that much exuberance over the last couple of years.
Yeah. Fortunately for our listeners and clients of yours and people we know, there's another option: real estate investing.
Yeah.
I mean, I would feel a little worried if my only option were the stock market.
Yeah. And when you look at the volume and the velocity of secondary offerings, pre-IPO secondary offerings, and you see what executives at some of these tech companies have been doing in terms of insider selling, I think it's a signal that a lot of people realize that it's probably just too much. But not everyone can get out, right? So,
right.
All right, Brian. Well, we wouldn't be the tech guys who invest if we didn't ask you some kind of a tech question. So we'd love to ask you a tech question. What's a piece of technology that would make your life easier as an investor?
I mean, and this goes back to my earlier answer to one of your questions. Before you invest in a deal or with a sponsor, ask them what the investor relations software they use is, because there are some awesome solutions out there. I mean, stuff that didn't even exist when I was in the business, and it just keeps getting better and better. We use Juniper Square, which we think is kind of best in class software. That's a white label, and it is so cool what it can do. And for my investors, they can get 24/7, 365 access to, historical financials, reporting. They can change their ACH information. They can change their address. We can upload K1s in a secure fashion, which we just got out today. It's just so much easier to handle as a sponsor, and the experience is so much better as an investor. So the investor relations software makes a big difference. And frankly, fundraising, having a good CRM makes things a lot easier for the sponsor, and I think the investors these days, because, again, compared to 11 years ago when I was sending people a deck and then we were doing a phone call or a coffee meeting, now I send people a webinar that we recorded over Zoom. So it just gives the whole pitch. We do a frequently asked questions component of it. We do a drone footage with the pitch subtitled, overlaid. And so we provide a Dropbox link with with the diligence and the data. So within 20 minutes, it's really binary. Like, what we do. This is the product that we have today. Do you like this deal? You can do a call with us, but it probably shouldn't be more than 5 or 10 minutes, because we've given you everything you need to make that decision. And it's just so cool to see how far it's come in the last decade.
That's awesome.
All right, Brian. Thank you so much for your time today, your knowledge. Where can people find you if they want to learn more from you, wanted to invest with you, and just learn more about Excelsior Capital?
Yeah, thanks for having me on, guys. I really appreciate it. I'm really active on LinkedIn talking about kind of tech. I just think it's incredible. That's how Adam and I connected originally. So I'm super active there. If you want to hit me up, send me a message, connect with me. Happy to talk. Brian C. Adams, Excelsior Capital. Or you can check out the website, excelsiorgp.com. And that's a good way to get kind of into our funnel to learn more about our opportunities. And you can check out all the resources that I mentioned on the website as well. Those are the two best ways.
Awesome. Thanks, Brian.
Yeah. Thank you all.